Africa's private market story at the moment is not one of retreat, really, but it's one of recalibration. And if we look at the latest Africa Private Capital Activity Report, I think what stands out is that the market is beginning to be more selective, more disciplined, and in some respects more mature. So fundraising has tightened, yes, but capital has not disappeared. It's become more discriminating. So investment activity has not completely collapsed, but it's stabilized. And perhaps I think most importantly, exits have also improved, which matters because private markets only truly work when capital can both enter and leave the market with confidence again. Now, if we look back in 2025, your Africa-focused funds that reached final close raised about $2.7 billion, and this was across about 16 funds, which is down year on year, but broadly mirroring the global slowdown in fundraising. And it sits within this wider private markets backdrop where global fundraising has been under pressure, again, because of disruption and has really remained weak. LP liquidity has also been constrained, and capital is increasing flow to managers with strong track records and much sharper specialization. And Africa has not been immune to that, but it has shown relative resilience in volume terms and even as value declined. And I think this is important because it tells us the issue is not that investors have lost interest in Africa. The issue is that the bar has gone up. Managers now need a clear edge, really strong thesis, and more evidence of execution. So sector expertise matters most. Strategy discipline is also important. And again, we can see from the latest report that points to healthcare, to agribusinesses, and energy as recurring areas of focus. While infrastructure remained relatively strong, your private equity funds activity actually showed the strongest momentum in 2025 for infrastructure. And that again suggests that capital is still available for managers and businesses positioned in areas linked to structural demand, essential services, and really long-term value creation. Now, if we look on the investment side, it's also interesting. Roughly $5.1 billion was invested across at least reported transactions, about 530 deals. Deal value was slightly down, but deal volume was up, making Africa one of the only major regional markets globally to show growth in deal count. And what that really says is that the market is still active, but the character of that activity is changing. It's less about exuberance and more about deliberate capital deployment. It's less about chasing headlines and headline valuation and more about finding opportunities where underwriting still makes sense. And you can see this playing out in the middle market as well. Smaller deals and very large deals both came under pressure, but this lower mid-market, particularly those in the 50 to 100 US dollar range, showed renewed strength. So, and yeah, we also saw venture capital also continue to normalize with fewer oversized transactions and more emphasis on sustainable mid-market rounds. Private equity volumes also rose, but again, we saw those check sizes fall. Private debt surged, especially venture debt, reflecting a deeper financing ecosystem and growing demand for flexibility and non-dilutive capital. We know there's some pressure in the private debt space globally, and I'm sure we'll see that play out also in the Africa context, but Africa's been way more conservative. So we should be spared from that. Infrastructure remained highly relevant, capital concentrated in the hands of really a few landmark transactions, specifically around energy and connectivity. So again, connectivity from a technology perspective, but also infrastructure spend. And you'll see from a lot of the new narrative coming forward, but also from the Africa Continental Free Trade Area initiatives, how infrastructure spend on rail, on roads and ports become very important from a inter-Africa and global trade perspective. And it's for these reasons that why I think the right way to read Africa private markets is this ecosystem is broadening beyond the narrow set of classic private equity transactions, but it's become more multi-asseted, more thematic, more tailored to what businesses actually need. And in some cases, that means equity. In others, it means structured capital, growth capital, venture debt, direct lending, and infrastructure capital. But what's important, I think, for founders, for family businesses, for mid corporates, this really matters. It means that there are more pathways to fund growth, but also more scrutiny around business quality, governance, and cash flow resilience. And I think here too, I think the exit picture is perhaps the most constructive signal of all, where Africa recorded about 81 exits in 2025, which is up year on year, about 27%, and the second highest in total on record. Year two, interesting to note, trade sales remain dominant route. Secondaries increased materially, and IPOs actively improved, although modestly as well. Local investors accounted for almost 70% of acquisitions, while international buyers were largely strategic acquirers rather than purely financial buyers. And this also tells us something important. Liquidity in Africa is increasingly being supported by an ecosystem depth, not just external capital arriving opportunistically. So for sellers, this is encouraging. It means that there's a much more credible path to realization than many would assume. But it also means the nature of preparedness has changed. So in a market where buyers are more selective and holding periods remain around the 6 to 7 year period, sellers cannot rely on momentum alone. They need to show quality of earnings, strategic relevance, governance maturity, operational visibility, and a believable growth story. And yeah, we know global private equity data increasingly shows that value at exit is being shaped less by multiple expansion and more by underlying revenue growth, operational improvements, and really disciplined preparation. And that lesson is just as relevant in Africa, if not more so. Now, also just taking a brief step back, but if we think about all of this in the macro context, the opportunity really is clear, but to do so, the conditions of success needs to be focused on, and it's becoming slightly more clearer. Sub-Saharan Africa growth outlook remains positive. Overall, the World Bank roughly 4%, 3.8 to 4% for was seen in 2025, and looking to average out at about 4.4 for 2027, 2026, 2027. With recent IMF updates also, I think highly highlighted this resilience, although we're still seeing a very uneven country level performance, and again, of course, continued global shocks, debt burdens, fiscal pressure, etc. But in other words, Africa still has the structural growth case: demographics, urbanization, digital adoption, infrastructure needed, and rising demand for essential services. But this macro dispersion across markets remains real. That means capital will continue to reward local knowledge, execution capabilities, and careful country selection. Now, what does this all mean for companies looking to expand, looking to buy? I think buyers need to recognize that in this market where conviction can be rewarded, but only if it's backed by discipline, Africa is offering more investable opportunities across financial services, technology, infrastructure, healthcare, and energy transition themes. But underwriting needs to go beyond the headline story of growth. Buyers need to need really diligent regulatory durability. There's FX exposure, there's working capital, behavior management, depth that needed, stakeholder concentration, and the practical scalability of the model. So in many African transactions, value is what are lost in the operational detail, not necessarily just about the financial engineering or spreadsheet optimization. Secondly, I think capital structure matters more than ever. With higher funding costs globally and more selective lending conditions, the best buyers will be those that can match the right capital to the right opportunity. And that may mean not overestimating a deal where flexible debt can support growth. But it may also mean not over leveraging in markets where volatility, currency exposure, and policy shifts can quickly test the business. So the rise of private debt and alternative capital across the continent is useful, can increase and broaden your capital stack, but it can cause, or it can create more options, but it also requires much more sophistication in that deal design about how you put your capital stack together, and also how you put your shareholder cap table together. Strategic buyers should really think beyond a single event. In Africa, the real question is often not just can we buy the business, but can we integrate it, can we scale it, can we localize it, can we build a stronger platform around this? And the buyers who win will often be those who treat M&A as part of a broader growth architecture, market entry, capability acquisition, supply chain positioning, customer access, and adjacent expansions. It's something I'll also unpack in a next video where I talk about M&A and value creation. But all of this, what does it mean for, if we focus now on companies kind of selling, or sorry, buying, on the flip side, what does this market condition in Africa mean for companies to sell? Well, I think, again, the year two, the first implication is that preparedness now starts much earlier. So if exits are strengthening, that's good news, but buyers are not paying for potential in the same way they may have done in a bit of the early and easier cycles. They're paying for visibility, defensibility, and readiness. So sellers need to build the equity story before the process even starts. Clean reporting, credible forecasting, clear customer economics, proven governance, and management teams that can stand up to diligence. Sellers need to understand who most likely the buyer will be. In Africa today, trade buyers and local capital is especially important in this exit mix. This means positioning should not be generic. A company should know whether it's most attractive to a strategic acquirer seeking market access, or to a sponsor looking for a platform, or a regional consolidator, or to management and local investors. Different buyers will underwrite value differently. And the more clearly a seller understands that, the better they can shape the timing, the structure, the narrative of that process. On timing still matters. The readiness, so timing's important, but the readiness matters more. We're in a market where fundraising is selective, investment is active, but still very measured. And yes, exit is improving, but this creates opportunity, but not for everyone at once. So companies that come to market well prepared with strategic relevance and a clear path to growth are far more likely to attract quality attention than those waiting for broad-based waves of easy capital. So overall, the view is that Africa, the private markets are not moving in a straight line, but they are moving forward. The market is showing signs of maturity, so tighter fundraising disciplines, more balanced deployment of broader financing tools, and healthier exit environment. For investors, this means the opportunity remains very real, but returns will be earned through selection and execution. For companies, it means private capital should not be seen as the last resort or a simple funding source. It's increasingly a strategic instrument, whether it's for growth, acquisition, recapitalization, or exits. And boards and management teams need to think about, when they are thinking about buying or selling, the message coming through quite strongly is this market. This is a market of opportunity, but it's now much more clearly a market that rewards your preparedness, your precision, and your strategic clarity, which also implies for both buyer and for seller, and for teams and investment teams, the organizational capability that is required when looking at not just raising capital, but also looking at executing on transaction, the buying and selling. So merger and acquisition activity needs to be focused on strategically, not just from a transaction perspective, but also from an organizational capability perspective.